Welcome to the daily update, where we'll go over the action in the market for Monday, July 28th, and we'll see how things look for Tuesday, July 29th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, set another all-time high with the S&P, the NASDAQ 100, but the broader market ended up being kind of weak. So we're still seeing a pretty exhausted market. We're still over exuberant as far as sentiment. And you have people that just assume that the market is going to keep going up. Now, if you remember back to last March and into April when we were really going down because all the news that was coming out about the tariffs and the trade wars were being taken as negative, and then suddenly we hit some support in the S&P. We started to bounce up off of that, and the news was still coming out, but it wasn't taken as negative as before, and we were able to bounce up out of that decline that we saw. Are we seeing the opposite of that now? There was a major trade deal announced over the weekend between the U.S. and the EU, and there's talks about the U.S. and China having a trade deal. They're talking right now, but the market isn't really reacting in a big positive way. Does this mean that all this trade news and the shift has gone from being negative to less negative, where it had been really positive to less positive, as the market appears to still be exhausted? We're coming up into the end of July and things are still fairly positive from a seasonal point, but we have to be a little bit concerned once we get into August and September. We may go up, but quite often those end up being more difficult times for the market. We've had great August and we've had pretty good September. September is usually the weakest month of the year, but we didn't have any economic reports in Monday's session. But for the rest of the week, we're going to get a massive amount. Plus, we have the Fed meeting and making their announcement. They're pretty much not going to raise interest rates, at least according to what the market says. But what are they going to say? Because they've been hinting that they're still thinking there are going to be 2 rate cuts, 25 basis points each, between now and the end of the year. And if it's not going to happen in July, are they going to start to telegraph that it may happen in September? Because we're kind of running out of time on that front to have this completed by the end of the year. And then if they change that, and that SEP report that they come out with, if there doesn't appear to be at least the possibility of 2 rate cuts, what's that going to do to the market? Also, we have the 10-year yield, which is starting to get closer to that 4.5% level. And when it goes above that, that's something that the market will quite often treat as negative. So there's a lot of things kind of jockeying around, but for the time being, we're still positive on all different time frames that we look at and setting new all-time highs. Okay, so right at the open, we had a higher open. It might have been a little bit surprising that maybe the futures, when they opened Sunday evening, why weren't they higher than they were? I mean, this was a pretty big deal. It really had an impact a few months ago if you talk about a trade deal between the U.S. and the EU, but it was positive, and the market will kind of digest it. And of course, there's folks that are going to talk about how this is a good deal. There's other folks that are going to talk about how it's a bad deal. It's what does the market think? That's the ultimate determining factor for what we look at here. But we did have a higher open, and we hit resistance, and we also set the intraday high right at the open at R1. Notice a round number, 6,400. Not only is that a psychological level, but for a Monday session, that was a pivot point. And I update the pivot point later on in this video. It's updated every day on the YouTube community tab. It's also posted on the website. So these are very important levels that we need to keep an eye on. We knew that ahead of time. That, okay, if we go up to 6,400, watch that. That might produce some kind of problem. At least limit the gains And then that's where we set the high, and then we started coming down from there. So we declined down below the unchanged level. We did find support at the daily pivot. Again, we know this ahead of time that that level is already there, and it was at 63.84. Then we tried to bounce back up and stay above the unchanged level, but then later on we fell back below the daily pivot to slightly above the 63.75 level. Again, another round number that sometimes the market focuses on. Then we did see some late day buying because it looked like we were possibly going to close negative, that we had a mixed session across all the different indexes. But this late day buying was able to help prices climb back above the daily pivot and close just slightly positive. Virtually unchanged, but a little bit of an up day, so it counts as a positive day there. We were up 0.02% on below average volume there. And as I said, we are positive on all time frames. We're looking overextended with a lot of our, but we've been looking overextended with a lot of our indicators for a while. But we're just seeing a market that looks tired, but it's looked tired. It's kind of like driving a car up a steep hill. You're really pushing it to go up, and it's going fast, and it's moving really well. And then the more you get closer to the top, it's like, okay, now the car starts to wear down. You're still giving it the gas, but it's not making as much progress as it was before, as it's getting close to the top end of that hill. And is that something that we're dealing with right now? Now, what's it going to be? Are we going to just go sideways? Are we going to pull back? Is there going to be a decline? That's what we'll evaluate as each day unfolds. Or are we just going to kind of rest at the top of this hill, maybe get some gas, give the car a rest a little bit, get back in, and then keep going higher? That's kind of the analogy that I'm trying to use to point out what the market looks like right now. All right, so some comments. The S&P, NASDAQ 100, NASDAQ all set new all-time highs again, and that's positive in and of itself. And then there was an announcement of this deal between the U.S. and EU with a 15% tariff, and there's really no exceptions to that. 0% carve-outs for certain products such as aircraft, components, parts, semiconductors, equipment, and certain raw materials. There might be some negotiating that needs to go back and forth there. And then one thing that is quite positive here, the EU will invest 600 billion in the US and purchase 750 billion of US energy. They get a lot of their energy, if not most of it, from Russia. And if they're going to jump over and buy it from the US, that's seen as a positive thing as well. And they are talking right now in Stockholm, Sweden, officials between the US and China. And so they've already started to talk. And earnings, for the most part, have been taken as optimistic. We had a lot of companies report last week. There's even more companies that will be reporting this week that are in the S&P 500. And again, this is a common thing where companies will come out and say, well, this is what we think we'll do as far as our earnings report. And then when it's finally announced, they beat that expectation because the market is thinking they're working off of what the company last said, hoping to get a bit of a bump in their share price when they beat the estimates. Then growth in semis. Now, last week, a couple of times, and what I was mentioning over the weekend is I was a little bit concerned about semiconductors. How come they're not doing better? There was trade deals that were announced between Japan, Indonesia, and the Philippines. Some of that had to do with semiconductors, and how come they're not seeing more of a positive pop because of that? Well, at least in Monday's session, semis came back and growth had a pretty good day. It was up where the other areas of the market were down. So we still have our usual charts here showing good, solid short-term momentum. Stochc RSI, Williams percent R, and both CCI charts. Stochastics, they're still extreme on all three of the different subdivisions of the time frame. Slope oscillator is still negative, but it's diverging from the other short-term oscillator that's actually going up, the TSI, the True Strength Index. We're still far away from the 20-period moving average, and the short-term RSI is extreme. Intermediate term, the CMB composite is looking extreme, and it's still going up. We're still up into the +3 channel with the standard deviations chart. And again, when you go across the spectrum of our momentum oscillators, that's why I use a lot of different charts. We're not seeing the same thing. Some are looking a little more positive, some are looking negative, some are pretty much flat. But the PMO and a lot of the momentum oscillators are still giving us extreme positive readings there. The Sean trend meter, the bullish percent index for the S&P, that's above that 70 level. We're also far away, as measured by the boom indicator, from the 50 period moving average and then the intermediate term RSI. But it hasn't rolled over yet. It's both the short and intermediate term RSI charts are still going up. They won't officially be considered overbought until we come back down and drop below that extreme level. The only thing I added to the scenario is that the announcement will be on Wednesday with the Fed. Are they still going to come out and say, wait and see, wait and see? It's pretty much assured that they're not going to cut rates. So are they going to hint that there will be a cut in September? And a year ago, that's when they cut rates. They did a 50 basis point cut then. Of course, then some people said that was a great thing to do. Other people said that was a terrible thing to do. We just have to take what is presented and then see how the market reacts to it. The dollar was up. It's actually coming back above its 50-day moving average. That could put some pressure on stocks because the dollar has really been going down, and that's what's been helping stocks go up is the weaker dollar. Stocks like a weaker dollar because of the currency conversions and the import-export relationships there. It makes it look better on their books that they're earning more money. So if the dollar starts going back up, is that going to pressure stocks? Interest rates were up. Again, we're at 4.42%. We really watch this if we get to the 4.5% level with the 10-year yield, where after Friday we were at 4.39%. We're positive here at 74, but we're either at or near during the day that 75 and above level. That's where we're extreme positive, but we've been there for quite a while now. And then our trend is still positive. The ADX is, we're seeing something interesting in that chart that I'll pull out. The green line is actually starting to roll over, and the green line's above the red line, so we're positive. But to have an up day, barely up, but it's picking up a little bit of weakness. And I'll go through that chart as well. And the bias is positive with the up day, and the last number of days, the momentum is also positive. All right. We did not have any economic reports. I forgot to change that slide. But since nothing came out on Monday, there'll be a lot of stuff later on in the week. So we jump over to Isabel Net blog charts, 3 months above the 20-day moving average. And I've tried to point this out a few times along the way that once we finally got above the 20-period moving average, and it looked like, okay, things are actually switching back and looking more positive. We've stayed above that. And this is how does the S&P perform after 63 days above the 20-period moving average going back to 1950. So 1 month out, we look positive, but 60.7% of the time. It improves the further out you go here, with 3 months being up 2/3 of the time, 70% after 6 months, and 73.8%. So not always. 1965 seemed to kind of ruin this whole idea here, but it tends to perform pretty well. I mean, we're above what's considered to be the short-term moving average. And when we see corrections and sideways action and the market doing internal things to correct in one way without it dropping below its 20-day moving average, that's quite a positive thing. Consolidated equity positioning, seeing that actually coming back above zero and climbing now, so it's more net positive than it was. Then once a week, we get the legal insider transactions ratio, or if they're buying or if they're selling, coming down a little bit here, but still more up into this bearish area. And when I say legal insider transactions, I mean like CEOs, corporate officers, not the illegal kind like you saw in the first Wall Street movie. And outside of the pandemic boom, this has been the best 3 months for stocks that are shorted. It's like, okay, they think the stocks are going to go down, and so they short them. That means they sell to get in, hoping to buy them back at a lower price. But those stocks have been doing quite well. So a lot of those folks that short the market have not been really happy lately. You have people that are perma bears. No matter what's going on, Even though the market goes up about 70% of the time, they're focused on that 30% of the time, and that's all they focus on. No matter what kind of evidence you throw out there, they still think we're going down. Well, sometimes they don't do so well when they look at things that way. There's the realistic approach that says, okay, the market usually goes up about 70%, then it goes down 30%, and that 30% can be pretty intense and it can be pretty painful. But okay, be a realist and say the market goes up and it does spend some time going down. Then speculation has really gone up. And I pointed this out over the weekend as well that okay, they bought all the quality stocks and they're seeing some gains in that. So now they're starting to go to this, well, let me put a little bit of money into this more gambling type of stock. Maybe they don't have much in the way of returns, or I think maybe that they will, and they don't, their earnings are not all that strong. Maybe they're a newer company, they're not as far established. And that might be what's kind of helping the mid caps and the small caps do a little bit better. It's like, okay, we put money into where we wanted to go that we think is good quality. We've still got some money now, or I have some capital gains that I can use to my advantage. Let's go look at some more speculative things here, and we're seeing a real increase in that. Then gold trapped in a holding pattern, and again, I brought this out over the weekend. Gold has really been going sideways since we hit the high here back in April, and it's still the best performing asset. It hasn't lost those gains. It's just kind of hovered right around the same place where it was at before. And then the most heavily shorted stocks have rallied hard. This goes similar to the chart I just showed a minute ago over the last 3.5 months. Yeah, people short the stocks and then they go up. And when you short a stock, then there are different alternatives. There are inverse ETFs that go up in value as an index goes down. I use those heavily. There are put options that you can do where you have more limited risk there because what you put into that option, that's all you can lose. Where your losses are virtually unlimited if you directly go in and short the market. And so that's why they have a lot different requirements here. But they've really been doing well lately. And then credit card debt, it does draw back. It's drawing back now a little bit, according to Yahoo Finance, where it's been getting hit up here pretty high. And folks are having to live off credit cards just to buy groceries or to have any kind of fun, just to kind of get by. And that is a concern, but it's also a concern for the federal government, but they just keep adding to that debt anyway. And then options positioning here, unlike the mania in 2021. Now, this is kind of contradicting some of the conclusions that I've been reaching here. There's not been a surge in the percent of large stocks with an inverted call skew. It did get up there. It was up there for a few days. It dropped down after last Friday. This is a variation of the skew index, where the VIX itself uses at the money options to be calculated, where current prices are at. The skew index looks at, okay, the prices above and below the current prices. And when they think there's going to be a big move, either to the upside or the downside, folks get into those either usually considered out of the money type of options because the stock has to move in that direction for that option to become profitable. Now, I've been seeing a pretty high reading here, but they're saying, according to this, if you take a bigger picture look, that it suggests speculative behavior remains relatively isolated. Okay, other things that we're looking at right now contradict this. But again, there could be some more speculation on the way. Mid caps and small caps still have a ways to go. We're seeing a real increase in penny stocks that are under $1, that are being a little bit more, seeing more action right now. So we'll just see if this continues to play out, because this goes against other things that we've seen. Then hedge funds versus tech, they're not in tech all that much. The prime book is now underweight when you look at tech against the MSCI World Index by 11.2%. Okay, and then they come up with their percentile stuff. So this could also end up being positive if some of the hedge funds out there, which can be the big money, but it's not the smart money. The smart money are the big institutions and the pensions and the banks and things like that. If this was to turn and start to go up, that could end up giving some support to the market. The basic scenario that I've been going with right now is, yeah, the market's exhausted. We're setting all-time highs. But if we do start to decline, it looks like it would be a normal decline, something that just happens. Markets don't go straight up. Sometimes they seem like they're going straight down, but there are bounces along the way. And so if we do start to go down and see a little bit more weakness into August and September, it just looks like something more normal. Now that could always shift. That's why I do videos every day. We reevaluate that day after day to say, okay, it's just looking normal here. But if it starts to turn into something more aggressive, we pick up on that and say, no, we're shifting over to a more negative stance. Then Magnificent 7 all-time highs. It took 159 days, but the Mag 7 stocks recouped their losses since December and closed at a new all-time high. So these have not been showing the huge leadership that we were seeing about a year ago, and especially after the 2022 bear market and then coming up in 2021 into 2022 and then 2023 and 2024. Those were the stocks that were really getting us out of those lows. They haven't been doing as much of that lately, but they're starting to come back and look like they're taking more of a leadership role. All right, then S&P 500 earnings hook. The current earnings reporting season is already starting to show an upward hook. This is the red that we see down here. That this is where they thought it was going to come, and it's actually turning up, which is also positive. So it's beating expectations. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here's the intraday chart. It really wasn't all that an exciting day. We set the high pretty much at the open and then couldn't get beyond that a little bit later on. And then we drifted down, went negative, found support at the daily pivot, tried to stay above the unchanged level, but then fell down below. This is when things turned a little bit more negative. We dropped below the daily pivot. Didn't quite get down to the 63.75 level. Never got down to S1. And then we just chopped along sideways and saw a little bit of late day buying to take us actually a little bit positive on the day. So we're pretty much flat because we got a lot of reports coming out now. So not seeing a real lot of initial overnight reaction here. Seeing an improvement on this chart where growth was up, value was down. So the blue line is above the red line intraday with the large cap growth versus value. This improved. A little bit of a concern. We saw a drop off in Friday's session where we're now resuming more of an uptrend. So even if we pull back, this is still looking healthy more under the surface. End of day, here's where growth was up, value was down. It was down less for the mid caps and less for the small caps. So we're seeing an improvement, but we're pretty much range bound, but it's a positive range since we're in an uptrend here with small cap growth to value. You can see the small cap index just it actually ended up being down just a little bit. Mid caps also down on the day. They are trying to break out a little bit here, but they're looking pretty solid as far as their growth to value ratio. This is setting another new high. This is also positive. S&P growth to value. So we're improving here with the growth to value ratio between these two ETFs, and we're going up here with the high beta versus low beta. That's positive. And we're going down with this ratio. Now we haven't quite surpassed this low that was set recently here, but this means value is underperforming tech, and that's positive for the market. And also a little bit of an improvement here with the discretionary to staples ratio. That's what we want. We're seeing, at least in Monday's session, it's not like discretionary did great, but we saw weakness here in staples, which are more defensive, and that caused the ratio to go up. Setting another new all-time high with large cap growth ETF. That's always a positive thing there. Our trend, this is in the short term. Notice how we got right up close to that 40 level, and the green line is starting to roll over. Now, it's still positive, and we're still trending. We're above the moving average. Now, if The black line, which is the ADX, that's the actual indicator. If it goes above 40 and the green line goes above 40, that's going to be an even bigger warning sign. But other times, we got close to this with the green line, specifically back in November. And it didn't mean that we went down all that much. I mean, we spiked up and then we went sideways and then saw a little bit of a decline before we recouped after that. So it's not necessarily the end of the world. What's going to be interesting is if we see the ADX and the green line go above 40, if it even makes it to that level. And a similar thing here with the intermediate term chart. And this is the one I focus on. We're still going up above the moving average with the ADX. The green line is on top, but rolling over. Didn't quite get to 40. But we're just watching that, and the red line continues to decline. So this is still positive here. We did drop to back below average here with volume, and we'll have to see. I mean, here we are, the last week of July into the early August. This is the big vacation time, and so it wouldn't be surprising if things settle down. But we've got some heavy-duty things that are going to be hitting the market this week, so that could... If volume stays low, that could produce more of a swing, either positive or negative. If volume comes back in, that'll show a bit more conviction, whether it's positive or negative. And we get this once a week, 73.79, still at a very high reading here with the sentiment composite index, which we're getting 74 right now on the daily index that we look at. And then this is another thing to be aware of. This is VIX seasonality, where we tend to see the VIX declining, and then we start to get into August, and this is where the VIX goes up. And when the VIX is going up, that means stocks are going down, and then we tend to top out in October, sometimes early part of October, maybe even a little bit into November here, before we see more of a positive bounce. Are we going to see a similar pattern to that this year? We don't know. We want to know about this ahead of time, so we're not just kind of blindly going through all this. But we are coming into that period where we can quite often see some more negative action. We're still declining below 20 with the VIX, both with the line. We were actually ticked up a little bit on a closing basis, but we're continuing to go down with the bar chart. We're still below declining moving average with the VIX of the VIX, which measures the volatility of the VIX itself. We ticked up a little bit with this fear gauge. We also ticked up a little bit with this other fear gauge. So the giving back those early gains and closing barely positive, that brought a little bit more fear into the market according to these charts. But we did see a real drop off. Now, before Friday's session, actually during Friday's session, we saw a big move up with the put call ratio here. A lot of people were buying puts. Now, you could have said, because we saw the skew index really drop, that could have been a lot of call options that were being sold, rather than a lot of new put options that were being bought. And so that really spiked this up, and it really came down in Monday's session. But we're still going up with the 5-day chart and the 10-day chart. So this is showing an increase of hedging, bringing a little bit more fear back into the market. We're still going up with the high beta versus low beta, the risk on to risk off, high beta versus the equal weight. This is continuing to go up. That's positive. That's more risk on. But we're getting a very high reading here. We're not seeing it in the VIX. We're not seeing it in some of our other sentiment gauges, but we're getting a really high reading here. So we just want to respect this with the volatility risk premium. And we did decline a little bit, but still looking solid with the advanced decline line based on price and volume. Declined here, but still above zero with the advanced decline ratios. Declined here, but above zero with the 10-day advanced decline oscillator. And saw a drop off in the new highs, but we're still going up with the 5-day and 10-day moving average charts. Still positive here with accumulation distribution, but now we're just trailing along here and dropping a little bit below the moving average with the boom indicator. And as I pointed out over the weekend, we were going up with the indicator. We've been setting lower highs here with this modified MACD. That's really all this is. And that might just suggest a little exhaustion there, even though in the bigger picture, this chart is still positive. But when we go to the chicken money flow, we're continuing to decline, and the red line's going down. So that's negative, and we're continuing to decline below the moving average with the chicken oscillator. A little bit of a tick down, but we're still positive here with the vortex. The green line is above the red line. Still looking okay with our advanced decline line studies. All the indexes are above advancing moving averages. We declined with those stocks in the S&P above their 20-period moving averages. And again, I'm trying to point this out. Where we've been going up with the S&P, we've been setting a lower high right now with this particular indicator. That could be a negative divergence. You could also make a case with the 50-period moving average study, going up with the S&P, setting a lower high with this particular way that we measure things. And we actually came down a little bit with the 100-day moving average and declined with the 200-day moving average study. So we are setting all-time highs. We're above this pivot point now as we get ready to finish out July. Here are the pivot points for August. That's the cool thing. We know about these ahead of time. We're in an uptrend with the S&P, but we're dropping off to below average with the volume. Declined a little bit with the 20, 50, and 200-day moving average study. But in the short term, still looking really solid with the Stochk RSI. Came down a little bit, but still looking really positive with the Williams percent R, the CCI 14, and the CCI 20. All of three of the stochastics charts rolling over a little bit here, but still extreme positive, and declining and just a little bit above the midpoint and positive with the force index. The condition of the short-term trend measured by 20 periods, that is still going up. We've slowed down quite a bit, so the green line and the blue line are still right on top of each other. And we're up into the +3 channel with the standard deviations chart. And we're also seeing a bit of a negative divergence here. The balance of power, we were going up with the S&P. We were coming down with the balance of power. It ticked up a little bit. It's still positive in the bigger picture, but seeing that negative divergence, we just want to make note of that. CMB composite continues to go up. It's extreme positive. Still positive with the go, no go. Darker blue bars. Still up here with the highest high value. And again, this is more time. Now it's green, so that's positive. But the longer this goes on, now we're getting up to 60 right now with this reading. Since we started this uptrend right at the beginning of May, according to the Landry Light. When we get above the 40 level, that's where it's like, okay, this has gone on for a pretty long period of time now. We're still adding to the histogram here and still positive with the proper order, but we're seeing another negative divergence. The TTM squeeze continues to decline as the S&P has been going up, still floating along just barely above zero with the ease of movement, and still looking positive and not necessarily extreme, but close with the Arun. More buyers, they're in control right now. The red line, that's sellers. We're seeing a decrease in that. And we're dropping back below zero. Some little internal weakness in the S&P, setting an all-time high, but the McClellan oscillator declined and is now back below zero. So we're starting to go down a little bit here with the summation index based on price and volume. Also, never did get back above zero after crossing below it with the NYSE McClellan oscillator. Little bit of broad market weakness here as this continues to decline. So we're going down with the summation index based on price and ticking down just a little bit here based on volume with the summation index for the NYSE. And we were positive after Friday. Now we're switching back and looking more negative with the Swirling Trading Oscillator based on price and volume. And here's where we're still extreme positive with the PMO. We are still above the moving average based on price. We're right on the moving average based on volume. So we're declining a little bit below 50 with the PMOs that are rising. The buy signals are starting to come down a little bit, but still above 50. But we're still getting a pretty high reading here with those stocks that are above. They're going up in the S&P with the PMO. And positive with the Elder's Impulse system for the S&P. Positive with the Parabolic SAR. Trying to turn up, but still below the moving average with the slope oscillator. But we're still extreme because we're above this green line. Actually seeing a little bit more of an improvement with the MACD. But it's not really clearing its moving average yet. So we're seeing a mixed signal here in the short term. Slope is improving, but still negative. Where the TSI, that's actually positive, but it's extreme also. We're pretty much flat with the MACD, PMO, and PPO. These are intermediate term. We're flat and slightly declining with the TRIX and the KST, which are long-term oscillators. Negative but improving with the Copic curve. Flat but still extreme positive with the Sean trend meter. Really going up here. The money flow picked up something that it liked, but it's looking positive and not extreme. Where we declined a little bit, but still above 50 with the ultimate oscillator. Really looking good here. On balance volume is above the advancing moving average. And we're still extreme with the intermediate and short-term RSI, and they haven't really started to roll over, at least yet. Then short to intermediate term here with the trend, all the lines are going up and prices above all of the lines. With the bow tie method, intermediate term trend still below the red line, but above the blue line. I do know my colors, and these lines continue to go up. So for right now, the intermediate term trend is still looking quite positive, and we're above all of these moving averages, and the moving averages are going up. But we're still far away from the 20 and the 50 period moving averages as measured by the boom indicator. We came down a little bit with the bullish percent index, but we're above 70 and we're still above the moving average. And we saw a little bit of a tick down with the NYSE bullish percent index, but a little bit of an improvement right back up to the 70 level with the NASDAQ 100 bullish percent index. So it was the bigger stocks that kind of held things together in Monday's session. And we want to keep an eye on this. This is a long-term chart. We're looking at the 64.68 level here. If we go up, watch that. If we do keep with prices rising, this could be overhead resistance. This is a weekly chart, and this is long-term overhead resistance. If we do continue to go up, we might bounce off of that, and then we could see some kind of a pullback from there. Now, if we break through that, that'll be positive, but we have to close the week above this level as well, and there's still 4 trading days left to go. So we're looking positive, though, on a trending basis with the Heiken Ashi, the Kagi chart, the Renko chart, and the 3-line break. Those are all positive, and we saw enough of an upward move early in the day to produce another green X in here. So we are still looking more positive with the point and figure chart. We're coming down not quite extreme with the 150 period moving average study, but we're still looking good with it, and we're still looking okay after a slight decline with the 200-day moving average study. Positive on all time frames across all the indexes, negative with bonds on all time frames, actually switching to an uptrend with the dollar because we're back above the 50-day moving average. They might use a 20-day moving average to measure the short-term trend there. And we saw energy, tech, and discretionary. Energy bounced up. That was likely due to the trade deal between the U.S. and the EU, with the EU buying a lot of, I got $750 billion of energy. Yeah, that would make things go up in price. But the 2 growth areas, tech and discretionary, they were up. Communication was down. It got hit a little bit there. So S&P with a new all-time high, NASDAQ 100, which is not on this list, and the NASDAQ setting a new all-time high. And briefly, we got above the 6,400 level there. With the utilities, this is considered more defensive. But as I always say, you could make a case that this is now a growth area because of AI and all the needs for electricity. We had a BPI cross back below 80. So a lot of red over here in this area. We were mixed a little bit with communication, where Meta was up, Google was down. Discretionary, both Tesla and Amazon were up, and Nvidia was up, Microsoft was down, Apple was up barely. So not an awful lot of conviction here. We came back down slightly below this pivot point with the Dow. We're still looking pretty positive here. It ended up closing lower on the day. We've gone from positive to neutral with the Elder's Impulse system for the diamonds. This is still looking pretty solid. We look at the NASDAQ, really nice looking pattern here. Are we going to be able to get up to this pivot point here, and will that end up providing overhead resistance? And we're positive after being neutral with the NASDAQ when looking at the Elder's Impulse system. Also, a pretty good looking move here above this resistance level. Also, another R1 level that if we get up to that point that the NASDAQ 100 may deal with. We're still positive with the Qs, with the Elder's Impulse system, but the momentum just kind of drifting off. Bit of a negative divergence. We're going up with price with the NASDAQ 100. This continues to go down. That's what we're starting to see develop in a lot of different areas, are these negative divergences, which is suggesting that the market is exhausted. But we can't try to pick when it's actually going to either go sideways or actually decline. We just kind of have to watch this unfold and then be ready for it. Also, a little bit above this long-term trend line with the NASDAQ 100 weekly chart. Again, as I've been pointing out, about the time we hit this is when we started to slow down. Even though those chart patterns for the NASDAQ and NASDAQ 100 are looking more healthy than they have been for the S&P. Small caps still above their 200-day moving average with the S&P 600 and getting close. Not quite there yet, but getting close to a golden cross with the Russell 2000 small cap index. Still neutral with the Elder's Impulse system for the small caps, and can't seem to get above this pivot point right here with the mid caps, just starting to generate a golden cross now, but they're neutral with the Elder's Impulse system for the mid caps. Down just a little bit after setting an all-time high with the Wilshire 5000 broad market measure. Also down a little bit with the total U.S. stock ETF, but still looking quite healthy here. Financial sector, it was actually down after setting an all-time high on Friday. We're still a bit concerned as the financial sector has been underperforming the S&P, and it's still below its 200-day moving average with this ratio. We were up with the FANG index. These are the big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia, and so forth. That's setting a new all-time high. And then the Dow Jones Semiconductor Index, after it had been underperforming, it came roaring back on Monday and set a new all-time high. Now we look at another semiconductor ETF. That's not quite back to an all-time high yet, but it was up also. Apple was virtually unchanged, but up slightly. We were up over 0.5% with Amazon. Microsoft was down 0.25%, but still looking pretty solid here overall. Google was down 0.31%, just now generating a golden cross. Nvidia, recent golden cross, up 1.87%, setting a new all-time high. Meta was up, but still above its 50-day moving average. Tesla trying to get above these moving averages again. It's barely in an uptrend, but it's been really choppy lately. It was taken down over 8.5%, or it was over 8% last week, and then it got 3% of that back, I think, on Friday. Another 3% was got back in Monday's session. And then Netflix, it's still continuing to fall. When we were going through all that mess, this chart was still hanging in there pretty good. And then it was just setting new all-time high after new all-time high. Now it's pulling back, and it's underneath its 50-day moving average. We're still seeing the staples to tech ratio going down. That's positive. That means staples are underperforming tech. And we're bouncing back up here. This is what was causing a concern last week for me. We saw the semi to tech ratio going down. It bounced back up in Monday's session. Can it continue to go up? Or is this just a little bit of a bounce before this gets set to go down further? And still fairly strong here with the short-term correlation between U.S. and world stocks. It's starting to show a bit of an improvement with the longer-term correlation. Oil, it was up. We're getting into the kind of higher end of the upper 60s, or the mid 60s, I should say, close to 67. And for the first time in quite a while, the dollar has now been able to close above its 50-day moving average, but it's got a lot of damage to do. It was in a pretty severe downtrend here. The latest Truflation reading coming in a little bit over 2%, where we did get 2.7% with the latest CPI reading. We are going back up here with the 10-year yield. We get really concerned if we get back up to this red line, but we're not there yet, but we're not that far away either. Still above the 50-day moving average with the 10-year based on price. And a little bit of an improvement with the Qs to S&P ratio. It came back above its moving average. The discretionary to the S&P, that's also slightly above its moving average. Looking a little more positive when we compare large cap growth to large cap value. It's above an advancing moving average. So the large caps, mid caps, and small caps, they're all above their moving averages. Still declining with the staples to tech ratio, and that's positive when this ratio is going down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. All right, the outlook. We still have 38% of S&P 500 companies that will report earnings this week, so it's a heavy-duty week for that. We're positive on all time frames, and we are trending. Then on Tuesday, I did update this part. We'll get the advanced international trade in goods as well as wholesale and retail inventories. Not a huge report, doesn't have that much impact on things, but we still like to pay attention to it. We'll get the FHFA Housing Price Index, the Case-Shiller Home Price Index as well, so we're going to get some housing data. And consumer confidence will also be coming out, and the JOLTS job openings, which we're keeping an eye on that. We've been seeing some contradiction between this report and what we get on Friday with the employment report. So this, if this comes in weak or strong or what have you, it could have more of an impact. But really, the market's waiting for what's coming out on Friday. And then anything geopolitical, whether it has to do with Middle East stuff, Eastern Europe things, more announcements about trade deals and tariffs and things like that. So here is the economic calendar. It's pretty heavy the rest of the week. The gold areas, that's what I deem as being the most important of the reports that are coming out. And we're seeing a lot of gold pretty much every day here on out for the rest of the week. This also shows what the previous readings were and if they have a forecast that goes along with that report. Seasonally, it's neutral to negative for the Dow, but we're just flat out negative for the S&P and NASDAQ for July 29th. That goes back to 2002. But if you look at it just during post-election years, we do see a little bit of a bounce down here as we go into the 29th of July. But then what often happens is we get a little bit of a bounce as we finish out the month. And then here just compares the first half of July with the second half of July. This also shows where we see we're in that time of more weakness now before we see a little bit of a pop. And this goes back to 1950. So the accumulation distribution is positive. It's above the moving average, but the boom indicator, it's below its moving average and showing us a bit of a negative divergence there. So that's why it's on the negative side, where the Chaikin money flow and the Chaikin oscillator, they are both negative. And now we have both the S&P and NYSE McClellan oscillators. Those are both below zero. That means the summation indexes are declining. The swell and trading oscillators declining based on price and volume. And I'm still keeping the momentum oscillators over on the negative side because we're just not really seeing much right there. But the Copic curve is negative. And the momentum for the NASDAQ 100. We're setting all-time highs, but that is continuing to go down. And then the long-term special K chart. It's improving, but it's still negative. And then we still have a very long-term Zohorchak method sell signal that is a full-on -10, which is a full-blown sell signal. Positive side, still really good things here. Growth to value, discretionary to staples ratios are okay. The parabolic SAR. We are extreme with the bullish percent index for the S&P. We did bounce up. We're almost extreme with the NASDAQ 100, and we bounced up here with the NYSE bullish percent index as well. And then I have a series of secondary indicators which are in white, the ease of movement, money flow, and ultimate oscillator. The vortex, which I count as a primary indicator, that's why it's gold, that's positive. Financial sector, when you look at it all by itself, it's positive. It's just underperforming the S&P. And let's see. Then here are the pivot points, which have already been updated on the YouTube community tab. So our conclusion has not changed. We're looking exhausted right now, but we are still positive on all time frames, and we continue to be in a trend. Thank you. I hope you found this helpful. I hope you have a great day on Tuesday, and I will talk to you in the next video.